Stop overpaying taxes on your investments. 17 expert strategies for tax-smart investing. Hey there, savvy investor. Are you tired of watching your hard-earned money get swallowed up by taxes? Stick around because today, we're diving into the world of tax-efficient investing. We'll share strategies that will help you minimize your tax burden and maximize your returns. But before we dive into those golden nuggets, go ahead and smash that like button. Share this video with your friends, hit subscribe, and ring the notification bell. That way, you'll never miss another video on mastering the art of investing. Alright, let's get started. Strategy number 1. Importance of tax-efficient investing. First, let's talk about why tax-efficient investing matters. Taxes can significantly impact your investment returns, especially when you're not aware of how they work. By implementing tax-efficient strategies, you can reduce the amount you owe in taxes and put more money back into your pocket. Sounds great, right? So let's move on to understanding tax brackets and capital gains. Strategy number 2. Tax brackets and capital gains. When it comes to taxes, not all investment gains are created equal. First, you need to know the difference between long-term and short-term capital gains. Long-term capital gains are from investments held for more than 1 year and are taxed at a lower rate, while short-term gains from investments held for less than a year are taxed at your ordinary income tax rate. Therefore, by holding onto investments for the long term, you can save a significant amount in taxes. Strategy number 3. Tax-advantaged accounts. One of the most effective ways to minimize taxes on your investments is by using tax-advantaged accounts like IRAs, 400 and Onyx, and Roth accounts. These accounts offer tax deferral or tax-free growth, allowing your investments to compound over time without the drag of taxes. So make sure to contribute to these accounts and take advantage of their tax benefits. Strategy number 4. Harvesting losses. Nobody likes to see a loss in their portfolio, but did you know that you can turn those losses into tax savings? That's right. You can offset capital gains from other investments by strategically selling investments that have lost value. This process, known as tax loss harvesting, can help you minimize your tax liability and even carry forward unused losses to future years. Strategy number 5. Index funds and ETFs. Another tax-efficient investment strategy is investing in an index and exchange-traded funds, ADFs. These funds generally have lower turnover rates than actively managed funds, which means fewer taxable events. Plus, they often come with lower expense ratios, leaving you more money to invest and grow. Strategy number 6. Asset allocation. Did you know that where you hold certain types of investments can impact your tax bill? Therefore, strategically allocating your assets across taxable and tax-advantaged accounts is crucial. For instance, investments that generate ordinary income, like bonds, are better suited for tax-advantaged accounts, while tax-efficient investments, like index funds, can be held in taxable accounts. Strategy number 7. Tax-efficient advisors. Consider working with a tax-efficient advisor who can help you navigate the complex world of taxes and investments. These professionals can assist you in creating a customized investment plan that considers your unique tax situation. Working with an expert ensures you're maximizing your returns and minimizing your tax burden. Strategy number 8. Municipal bonds. Another tax-efficient investment option to consider is municipal bonds. These bonds are issued by local governments and can provide tax-free interest income at the federal level. In some cases, they may also be exempt from state and local taxes, depending on where you live. By incorporating municipal bonds into your portfolio, you can potentially generate income without increasing your tax liability. Strategy number 9. Tax-efficient mutual funds. While we've already touched on index funds and ETFs, it's worth mentioning that there are also tax-managed mutual funds specifically designed for tax efficiency. These funds employ strategies like low turnover, tax loss harvesting, and holding securities long enough to qualify for long-term capital gains rates. By including tax-efficient mutual funds in your portfolio, you can further optimize your investments for tax savings. Strategy number 10. Dividend strategies. Dividend-paying stocks can be a great source of passive income, but they can also generate tax liabilities. To minimize taxes on dividends, consider investing in qualified dividend stocks, which are taxed at the lower long-term capital gains rate. Additionally, you can allocate these investments to tax-advantaged accounts, where the dividends can grow tax-deferred or tax-free. Strategy number 11. Real estate investment trusts, REITs, real estate investment trusts, or REITs can offer an attractive mix of income and potential capital appreciation. However, REITs often generate income that is taxed at your ordinary income tax rate. To make REITs more tax efficient, consider holding them in tax-advantaged accounts, where their distributions can grow without immediate tax consequences. Strategy number 12, Roth conversion ladder. One lesser-known strategy for tax-efficient investing is setting up a Roth conversion ladder. This strategy involves converting a traditional IRA, which is funded with pre-tax dollars, into a Roth IRA, which uses after-tax dollars. By doing this gradually over several years, you can manage your tax burden by staying within lower tax brackets. The Roth conversion ladder can be an effective way to access retirement funds early without paying hefty taxes or penalties. Strategy number 13, Qualified Opportunity Zones, QOZs. Qualified Opportunity Zones are another option for tax-efficient investing. These zones are economically distressed areas designated by the government to promote investment and development. By investing in QOZs, you can defer capital gains taxes, reduce your tax liability on the initial investment, and potentially avoid taxes on new gains from the QOZ investment. This strategy can be especially beneficial for those with significant capital gains from other investments. Strategy number 14, Charitable Giving and Donor-Advised Funds, DFs. Charitable giving can not only make a positive impact on the causes you care about, but it can also provide tax benefits. Donor-advised funds, DFs, are a great way to combine your philanthropic goals with tax-efficient investing. By contributing appreciated securities or cash to a DF, you can receive an immediate tax deduction while allowing your donated assets to grow tax-free. You can then recommend grants from your DF to your favorite charities over time. Strategy number 15, Tax-Aware Rebalancing. Rebalancing your portfolio is essential for managing your desired asset allocation and risk management. However, it can also trigger taxable events. To minimize taxes during rebalancing, consider using new cash contributions or dividends to purchase underweighted assets rather than selling overweighted assets. Additionally, prioritize rebalancing within tax-advantaged accounts to avoid triggering taxable events. Strategy number 16, Delaying Social Security Benefits. Delaying your Social Security benefits can be another way to minimize your tax burden during retirement. By waiting to claim Social Security, you not only increase your monthly benefit amount, but also reduce the likelihood of having your benefits taxed. This strategy can be particularly beneficial if you have other sources of income during the early years of retirement. Strategy number 17, Gift and Estate Planning Strategies. Lastly, tax-efficient investing isn't just about minimizing taxes during your lifetime. It also involves planning for the transfer of wealth to your heirs. By utilizing gift and estate planning strategies like annual exclusion gifts, charitable donations, and trusts, you can reduce your estate's tax exposure and ensure your wealth benefits your loved ones and causes you to care about. By implementing these strategies, you'll be well on your way to minimizing your tax burden and maximizing your investment returns. Now, we would love to hear from you. What tax-efficient investing strategies have you found most effective in your own portfolio? Share your experiences and tips in the comments below. Let's learn from each other and grow our wealth together. Also, remember to check the description below for valuable resources and extra info. Don't miss out. Thank you for watching. Until next time, happy investing